Hello investors, welcome to Simpli Stocks. The Q4 or the March quarter earnings season is in full swing, and today I have brought 4 new small cap businesses for you that have delivered strong results. In our previous video, I focused a bit more on value picks where I covered tips, DCB Bank, Bajaj Consumer and SBFC. But today we are going to cover specifically fast growing small caps. So you are going to like today's video, which will be part 2 of this Q4 FY26 result series. So now without wasting any time, let's get started. The first business that we will study today is Aurum PropTech. I started covering Aurum last quarter, and it is a unique business model. Aurum operates in the real estate sector, and they have 5 products or platforms, and these 5 are divided into 2 segments: rental and distribution. In the rental segment, the company operates 259 PG hostels across the country under the Hello World brand, where they manage almost 19,300 beds or seats. Apart from PGs, if you want to say rent a flat or apartment, then for that they have the Nestaway platform where you can find flats. And here they provide many services from property listing to rent collection and also agreements. And these two together make up their rental segment. But this is not a very scalable segment, I will say. And with the job losses happening right now due to AI, there has been a slowdown in the rental space in IT markets like Pune and Bangalore. Their main trigger is the distribution segment, which includes 3 platforms: Aurum Analytica, Sell.do, and PropTiger. These platforms are for real estate developers. Aurum Analytica and Sell.do help real estate companies with everything from lead generation and CRM, customer onboarding to transaction management. Then PropTiger is a platform like 99 Acres and Magic Bricks. So if I summarize in very simple words, these 3 products are for real estate developers so that they can easily sell their flats and properties. Together, this is their distribution segment, and this is the main trigger in this business. Now, coming to performance, for Aurum Analytica, the number of accounts grew by almost 23% year on year, number of projects by 20%, and the number of leads sold has grown by 93% year on year in Q4. In Sell.do, active accounts grew 38% and active licenses grew 32%. They are also using AI to automate tasks and workflows so that revenue per team member goes up and the efficiency increases. And here now, looking at the financial performance, you will see that total income has grown by 72% from last year. They had become profitable last quarter only, and this quarter margins have expanded further. You will see that EBITDA margin was minus 1.4% last year, which has improved to 12.2%, and the PBT margin has also gone from minus 11.5% to 2.5%. Last quarter, the adjusted EBITDA margin used to be 6% and PBT margin was 2%. So margins have improved, you will see quarter on quarter basis as well. And this sharp margin improvement which we are seeing in Aurum, that is why we are studying it, or that is why we are analyzing it today. Because in tech businesses, once a platform is built, expenses don't increase at the same speed as sales. So margin improvement happens very fast, and we get to see such a J-curve in profitability of companies. Also, their whole real estate tech suite is now well developed, and Aurum has a complete tech ecosystem for real estate sector where they provide all the services from end to end, right from paying PGs and flats on rent to buying a house, and then on the other side getting sales for developers. So they have products for all use cases, and all these products are well integrated with each other. So there is a lot of scope for cross selling as well. Plus, PropTech is an emerging fast growing segment in India with a market size of 39,000 crore rupees. Both Aurum Analytica and Sell.do are among the top 3 platforms. Aurum also has no threat from AI. For them, market data is a big moat which they have built over the years. Plus, you see, from a developer's perspective, it is such a high risk sector that when their project goes live, they try everything possible to get as many bookings as quickly as they can. For developers, already the work is so stressful, from land acquisition to project completion. Deploying their own IT platforms is the last thing on their mind, to be honest. Plus, every project has different requirements. That is why there is a lot of scope for platforms like Aurum in India. You will see all major developers like Tata Housing, Adani Realty, Embassy, Hiranandani, Lodha, and Prestige, all are clients of Aurum. So you can study this business yourself once. They have crossed the 500 crore ARR mark, and their target is that in the next 3 years, the company should reach 1000 crore rupees in sales. The management expects that they will be working on a net profit margin of at least 8 to 10%. And based on this, the 3-year forward PE comes out to just 14 to 18, which is very good. After Aurum, the second business we will cover is Websol Energy System. Websol is trending quite a lot these days. About 1.5 to 2 months ago, Websol went into an extreme downtrend, but since then, two positive developments happened, due to which it recovered and gave a good rally of 100% plus, also from the bottom. Now, let us understand all of this step by step. So, Websol started correcting mainly because Q3 results were not very good, and then some stress points also emerged. Because until now, the broader understanding was that there is pricing pressure in modules, but cell prices are stable. But in Q3, they saw a drop in cell prices as well. Besides that, the way silver rallied, so it also affected the margins of solar manufacturers. Big players like Vari or MV have done better research to reduce their silver consumption significantly. Websol has not been able to bring that same output, and due to this rise in silver, there is margin compression in this quarter as well. And apart from this, the risk of oversupply in the sector is anyways there. That is not going away. So all this led to sharp correction. But when their March quarter shareholding pattern was released, Vijay Kedia's name appeared in it. Seeing that, the market reacted positively, and then the results were also good. So overall sentiment regarding Websol improved. So results and Vijay Kedia's stake are two positive developments. Now, let us look at the results first. Then I will talk about management commentary and the future outlook. So here you will see that sales have grown by 132% over the last year to more than 400 crore rupees. EBITDA on an absolute basis has grown 86.4%, but the EBITDA margin has contracted. You will see that the EBITDA margin sharply declined from 45.4% to 36.4%. Even quarter on quarter, margins fell from 40.8% in Q3. And please do not take this casually at all. This margin correction is the very risk in this sector, in this stock. I will explain this in detail ahead. Then coming down, you will see that profit before tax grew by 89%. And here as well, the PBT margin fell from 37.9% to 30.8%. And we are not looking at net profit because there is a tax adjustment there. So the PBT figure is a better metric for us. Production has increased definitely because their second cell line went live. Because of this, top line growth has been quite good. The 600 megawatt second line has also reached 85% plus utilization. And if we add together both lines, Websol has reached 92% capacity utilization for cell production. This is optimum utilization, and there is not much scope to increase production from here. So I will not be surprised if Websol quarterly sales remain range bound from 400 to say 450 crore rupees going forward. Module production has reached at 74% utilization. But if you can read here, I have noted for you that there has been softening in cell prices. Cell prices have fallen from 16.5 cents to 13.5 cents in the last 2 years. That is why we saw such a severe margin correction in Websol, and this is currently the biggest risk in the solar sector. I won't go into detail again because I have covered the solar value chain many times on our channel. But if I summarize in one line, solar cells are currently a high margin product. But companies are bringing manufacturing capacity at a fast pace. Therefore, margins will keep declining from here. A good company is one that is able to earn as much profit as possible in the near term by selling solar cells, and then uses that money to either backward integrate or to enter into other businesses. But the way sector is moving, I personally feel Websol is a bit behind in the race. That is why I exited my Websol position, and as of now, I am only invested in Vari Energies. Like in this slide, you will see that although it is written here that they are bringing 2 gigawatt of integrated TOPCon cell and module capacity next year in Andhra Pradesh, but when they were asked in con call, I mean management was asked in con call about the progress, they said that it is still in planning stage. I am not feeling confident about when this capex will start and when when will the commercial production begin. And even if we assume commercial production starts by the end of 2027, then half of 2028 will be spent in just stabilizing the production. So for now, it is just this 1.2 gigawatt cell capacity that is there. Yes, they are also doing a capex of 250 to 270 crore rupees for upgradation of their one 600 megawatt cell line to upgrade it from monoperc to TOPCon. This will increase their nameplate capacity from 1200 megawatt to 1350 megawatt. TOPCon cells are bigger and more efficient than monoperc. The industry itself is shifting from monoperc to TOPCon. This line will start next year in February with the upgrade and should take 2 months to stabilize. However, bringing TOPCon won't fetch an improvement in margins. It will just help to counter whatever margin contraction is already happening in cells right now. Now, you will see Websol has done well from the bottom. And since Vijay Kedia has entered, you might be feeling FOMO. That is understandable. But please keep the oversupply risk in mind. That is a very serious risk. And the best example of this are Oswal pumps and Shakti pumps. So many players entered the solar pump sector that the entire margin profile got ruined. And regarding Vijay Kedia's entry, my take is that he often takes such high risk bets. And he has even admitted this when he invested in Global Vectra. So you should also look at what his buying price was in Websol and how much allocation he gave it to in his portfolio. Another concern is Websol generated 255 crore in cash in FY26, and all of it will get used to upgrade the 600 megawatt cell line. Then they will need the same amount again later to upgrade the second line. Then for the 2 gigawatt integrated line that is coming, a separate investment of 1600 to 1800 crore rupees will be required, and that is a big amount. Plus, this is just the beginning, because as you can see here that from June this year, ALMM 2 is getting mandatory. Then next year, the government has plans to even bring the ALMM 3 list for ingots and wafers. That will require even larger investment. For example, when I was in Vari's con call, they told that they have earmarked a capex of almost 6,200 crore rupees for 10 gigawatt ingot and wafer capacity, on which work has already started. Websol only has this 2 gigawatt cell and module capacity on charts, that too at planning stage right now. That is why I personally feel that solar manufacturing is a sector where big players will always have an advantage. They will stay ahead in the race by doing heavy capex in new areas. That is why, even though results are good, my future outlook for Websol is not very positive. Now, a humble request, just before moving forward, if you are liking this video so far, do give me a thumbs up. Also, you can subscribe to my channel Simpli Talks, where I bring multiple such videos every week, because honestly, your likes and subscribes are my biggest motivation, so that I keep bringing such high quality research to you for free. So do like this video, and yes, also subscribe to my channel. Anyways, let us get back to our discussion and quickly look at the remaining two businesses, Fedbank Financial and Capri Global Capital. Both are NBFCs and both are doing quite well in the gold lending segment. Aurum and Websol took up more time, so I will try to get done with these two quickly. Now, first, let us look at Fedbank Financial, then I will talk about Capri Global. Fedbank has mainly two segments, mortgage loans or loan against property and gold loans. Their total AUM has grown 27.5% year on year. But in this, the fact that they scaled down their unsecured business loans portfolio, that is hiding the true growth. If we look ex-business loans, AUM grew by 40.8%. In this, their mortgage loan segment grew by 16%, and the winner is clearly the gold lending business. As you will see, Gold loan AUM grew 76% and is now commanding more than 50% share of their total AUM. And although it is not written here, but disbursements or the fresh loans were more than 11,600 crore rupees, which is a massive 109% year-on-year and 13.5% quarter-on-quarter growth. Fedfina has exited from risky low-margin business loans. So if someone is looking superficially, they will only see that 27.5% loan book growth. But if you look closely, you will see a fast-growing NBFC. And now, as the FY25 base is behind us and the contribution of gold AUM in total AUM has increased, we should see the growth rate improving from here. In the same direction, you won't see anything special in, let us say, income growth. It grew by 17.5%, but the change in segment mix has positively affected other P&L metrics. Net profit grew 40% year-on-year, ROA has increased, and Fedfina's ROE has also improved from 11.4 to 14%. Asset quality numbers are largely stable. There is no issue over there. And here you will see that cost to income ratio has improved. That means they also got the benefit of operating leverage. Credit cost is not written here, but there is improvement in credit cost too. On next slide, you will see that if we adjust for the repo rate cut, yields have increased at net level. So spreads, or say their margin profile, has improved. That is also a positive point in their results. And here you can see the main growth driver is clearly the gold loans. For the last 4 quarters, the main disbursements have been for gold loans. LAP has had very little contribution. And what has essentially happened in the sector is that because of rally in gold prices, people are now able to take larger loans for the same quantity of gold. So lenders are also earning more interest income by giving larger loans. And that is why we have been covering Fedfina and CGCL for you. Another positive thing is that in Fedbank, growth has not come from just increase in gold rates. There is also tonnage growth. Tonnage growth was 12.6% in FY26, and I was listening to their con call for FY27. They have given a guidance, or say target, of 10 to 15% tonnage growth. At the same time, the target will be to take AUM per branch above 20 crore rupees. So combining tonnage growth, AUM per branch improvement, and also the new branch additions, although management has given a 20 to 25% AUM growth guidance, I personally feel that they can do much better than this. And management is being conservative because of the LAP segment. And in that, especially the small ticket mortgage loans portfolio, because that is not growing well. But if the war ends soon and business activity and the economy get back on track, we will get to see much better AUM growth. Then the mortgage loan segment won't be dragging down the overall gold loan portfolio or the overall AUM growth. Finally, let us also look at Capri Global, or CGCL, quickly. Capri's AUM has grown by a massive 60% from last year, and it is not written here, but their gold loan AUM has recorded 111% growth, meaning that segment has more than doubled since last year. So if you ask me who is growing faster between Fedfina or Capri, the answer is Capri. In this direction, 56% growth was visible in net interest income and 59% in net profit. Capri's asset quality has also improved. The business got good operating leverage. So the cost to income ratio has also improved. Right here, you will see that their non-interest income grew by 36%. This is the income that comes from selling products of other companies like insurance, credit cards, etc. They raised capital for future growth, which is why return ratios have fallen or decreased. Otherwise, those would have been better too. Capri has also grown its branch network rapidly. Their gold loan branches alone have increased by 25% over last year, and they now have, I think, almost 1,000, or to be precise, 999 branches for gold loans all over the country. In comparison, Fedfina's branch network grew by 30%. But see, you also have to look at the fact that Fedfina's base is also small. CGCL is still growing sufficiently fast on such a large base, and CGCL is ahead in tonnage too. They had 25% tonnage growth, while I told you for Fedfina they did 12.6%. And one more thing that works in Capri's favor is that their other non-gold segments are also doing well. Here you will see 38% growth in construction finance, 43% in housing loans, and 19 to 20% growth in MSME AUM. And although the composition of loan book has changed, but all segments except MSME did great. However, the weak point in CGCL is that yields on gold loans are falling, meaning the interest rate at which they give loans, that rate of interest has been decreasing. They are doing this to increase market share, but part of it is also due to competitive intensity. This point was highlighted by management of Fedfina in their con call, that competition is increasing in the sector. So yields improved in all other segments but decreased in gold loans. However, their credit rating has improved. So with the rate cut and credit rating improvement, we saw the borrowing cost falling from 9.7% to 9.2%. And the difference is more than the 0.2% drop in consolidated yield. Therefore, on a consolidated basis, spreads and net interest margins have improved. Although from here, we need to see that yields don't fall any further for gold loans. So both Capri and Fedfina are fast growing businesses, and you can study either any of them or actually both independently. Both are growing at 40-50% rate, and management of both has talked about growing AUM per branch even after such good growth. And this year can go well for gold lenders, so you should not take this segment casually. The rest, Aurum, which I covered first, that is also doing well. If you want, you can start understanding that business better by taking a tracking position. But my personal opinion on Websol is not positive. Although the results were good and the script rallied, I see more risks than opportunities over there. So I will say from fresh position point of view, you will have better opportunities in the market right now. Now, you tell me in the comments which businesses I should cover in the next video of our Q4 FY26 result series. Also, if you found this video helpful, please make sure to hit the like button and also subscribe to our channel, Simpli Stocks. If you support us, I'll be able to bring more such videos for you every week. So I will see you in the next video. Happy investing.